Hello, dear friends. My name is Clive Thompson, and this is Clive Jr. He's 8 years old. Today, we're doing the usual morning report covering the investment markets for the last couple of days. So, Thursday, October 16th. So, the big story has been extreme volatility in the markets, with markets plunging and then soaring and then plunging and soaring. It's been very, very chaotic in the market, and particularly with respect to the precious metals market. Now, last time I did my video, I had quite a number of you saying they could hear a background noise in the terms of some water trickling. And what I hadn't noticed was there was a fish tank nearby. I didn't know that the microphone was picking that up. And in fact, the microphone was picking up the noise from the iPhone on which I was recording this rather than from my earpiece. But I've now figured out how to get that right. So hopefully you won't have any background noise and there is no fish tank near us. Hopefully we'll have a little bit of peace where we are. And some of you were wondering where I am. I know one person said that perhaps in Florida, another person said perhaps in London, but you're all miles off. Oh yes, one person said Hong Kong, also probably thousands of miles off, I'm guessing. So we won't say where we are, will we? We'll see if anyone can guess where we are. There might be some clues appearing as we do this video, particularly if you see anything behind me. I don't know if there will be anything appearing behind me or not. So volatility, yeah, markets went up and down. And one of the things I flagged last time I did my video was the gold price. I said gold was at, can you remember what figure I said? Can you remember what the price of gold was? 4,100. It was indeed. It was 4,100 roughly. And I said that it was flashing red, and the RSI, the relative strength indicator, was warning that it was seriously overbought. And sometimes when things are seriously overbought, we have a severe, sharp market reaction, but it's not guaranteed to happen. Well, it took me about 2 hours to upload a 20-minute video because the internet was very, very slow where we are. And in those 2 hours, guess what happened? The gold price, it plunged. It plunged 5% in just an hour. But if you blinked, 5%. If it was four, can you work out what 5% of 4,000 is? Or let's say, well, let's not, yeah, do 4,000. 5% of 4,000? Yes. Wow. Yeah, that's a tricky one. We'll carry on. 200. It's right. 200 is the correct number. Well done. So anyway, it plunged. I don't know. It went up a bit higher after we spoke. I think it even went to 4,200, then went all the way back to 4,000. So it was a really roller coaster day. But if you blinked, you would not have noticed it, because no sooner was it down than it turned on a sixpence and went straight back up again. And you won't guess where we are now. We're at 4,236. It's an all-time record for the gold price. And it's not just gold pushing the all-time records. We've got silver hitting an all-time record as well. It's at $53.16. We had a bit of volatility last night on Wall Street as well. The trade war continues with each side playing tit for tat in their tariffs and their threats. So President Trump accused China of deliberately not buying soybeans from America. I don't know how you can deliberately not buy something, but anyway, that's what he said. And he said that in retaliation, America will stop buying Chinese cooking oil. I think that although that caused the stock market to plunge very briefly, it dropped a huge amount in a very, very short space of time, but it then almost immediately recovered. So it wasn't a big deal. I mean, I think most Americans figured they got bigger fish to fry in their cooking oil. Yeah, maybe playing a joke there. So anyway, but that wasn't really the big story. The bigger story is the worries about world trade. World trade is not doing as well as it used to because of all these tariff threats. So one of the biggest things going on is you probably see that President Trump has imposed massive tariffs on Chinese ships. That's Chinese-owned or Chinese-made ships which are docking in American ports. It means a large tanker containing crude oil or cooking oil or containers might have to pay $1 million or more, or millions maybe, in fines just for docking at it. So the reason for doing this was to reinvigorate the American shipbuilding industry, because the Chinese shipbuilding industry is the biggest shipbuilding industry in the world, and the American shipbuilding industry has gone into decline over the last many, many decades. So the thought that President Trump had was that if he puts large levies on U.S. tankers.
What are levies?
Oh, levies are fees which have to be paid when you do something like pass a gate or arrive somewhere or do something. So in this case, when the ship arrives in the port, depending on its size, it doesn't matter what's inside the ship, depending on its size, it's got to pay a fee. And he's decided to impose this fee on Chinese ships, but not other ships. So the thought he had was, if I impose a levy on Chinese ships, people will stop buying Chinese ships and will buy more American ships. And that will reinvigorate the US shipping industry. What perhaps was not anticipated was the Chinese then turned around and said, well, we're going to do the same thing. We're going to impose levies on American ships arriving at Chinese ports. So if you're a Greek shipowner who previously owned a ship well, you've got a fleet of ships, you're now auditing all your ships to see who made them, where they were made, whether they were Chinese made, in which case you can't use them in American ports. But so you're thinking, okay, before this new levy from China, you think I'll buy my ships from America and I'll be nice and safe. But now China has said they're going to pose levies on American-made ships. So you're a Greek shipowner with your fleet of ships. You can't buy from America and you can't buy from China because you've got these uncertainties about how high the levies will be when the ships arrive. And we're talking millions of dollars. And, that's not enough money to think about perhaps buying a Korean ship or a British-made ship. Do they still make ships in Britain? I don't know. They used to. Maybe they don't make them anymore. But anyway, it does mean that America has kind of damaged permanently, I would say now, damaged the US shipbuilding industry, because who in their right mind would buy an American-built ship, knowing that down the line, every time it docks at a Chinese port, it's going to have a levy, and those levies can rise in the future. So if you make a ship, you want to make a ship which can go everywhere at the least cost, not everywhere where not some of the places free of cost, and some of the places where it's going to be a high cost. So unfortunately, that one is not working. But what it has done is created a great deal of uncertainty in the world, because people, ship owners are having to reroute their cargo ships from port A to port B. So, for example, if there's a ship on the way to America now, it's got to think, well, do I have to take this ship to another country, hire another ship which is not a Chinese ship, and then offload my goods onto the new ship and then import them to America? So it's created a lot of friction, and somebody somewhere is going to be paying that cost, whether it be the ship owners, the Chinese, or the Americans remains to be seen. But it doesn't mean that the cost of buying goods is going down, that's for sure. We've also had in France a bit of political action. You may remember a week or so ago, the new president, who'd been president for half a day, that's President Lecornu, he resigned. I'm not going to say he resigned in a huff, but he brought out a budget, and obviously he's trying to balance the left wing and the right wing, and they both can't agree because they both got their views, and it was a bit of a battle. He finally said, look, I suppose he said, I'm not sure, I don't know what he said, but he probably said, look, you guys, we've got to do this. If you don't do it, I'm resigning and I'm out of here. So he lasted about half a day. But it seems that President Macron has reappointed Le Cornu as the prime minister. So he's prime minister again for the second time. I wonder if they had to give him a pay rise to make him come back. I don't know. So finally, they've got some sort of budget agreed, but he had to make some concessions to the socialists. Basically, there's a law in France about the retirement age going from 62 to 64, or at least that's one of Macron's plans. He had to concede that they'll abandon that for the time being, anyway, for a couple of years at least. That's going to cost the French money because it means that someone's going to have to pay for all these people retiring early. So the rest of the world is going from a retirement age of, let's say, 64 to 65, then 67. And France is going backwards. It's going from 64 down to 62. So yeah, it does mean that you've got more people who are going to be getting old age pensions, which are going to be paid for. So someone was asked, I don't know, it was one of the politicians, I don't know who it was now, I forget now, was asked, well, how is France going to pay this? And the answer came back very simply, we're going to borrow the money, of course. Well, of course, that's completely illegal because it's against EU law. They've already borrowed far more than they're allowed to borrow by EU law. The whole point of having a budget is to bring that deficit down. Anyway, the commentary on the budget is that it's very fragile and there's too many things which can go wrong and it's unlikely to work at the end of the day, but at least it's a plan. So that budget is unlikely to be adhered to. And of course, we see that the yield on French bonds is much higher than the yield on German bonds because of the extra risk. I think I wrote that down somewhere. Maybe I didn't. Don't have it in front of me. Oh, yes, I do. So the French 30-year bond is yielding 4.19%, and the German 30-year bond is yielding 3.15%. So French bonds are yielding more than 1% higher than bonds in exactly the same currency, euros, from Germany, which means that for the next 30 years, an investor in a French bond wants to get an extra 1% a year to justify buying that bond. In other words, he wants over the next 30 years an extra 30% on top of what he would be getting by a German bond just for taking the extra risk of buying a French bond. What's the risk? Well, obviously it's a very small risk, but it is out there, and the risk is that the European currency system starts to fall apart, and different countries go their own way because they won't obey the EU laws relating to
EU laws?
European Union law. So. Under the European Union, the European monetary system, they've got various rules as to how much you're allowed to have a budget deficit. It shouldn't exceed, I think it's 3% or something of your gross domestic product. I haven't got the figure in my head, but where there's a limit, and many countries have exceeded it. There's also a limit on how much debt you're allowed. You shouldn't exceed 60% of debt to GDP. Well, many countries are already at 100% of debt to GDP, massively in excess. So breaking EU law by the governments themselves is kind of par for the course, I guess. But at least they have a law to try and bring it. Just like the Americans got a law with the what they call the debt ceiling. In America, they've got what's called a debt ceiling, which gets passed every few years. And the debt ceiling is a rule which says the government can't keep borrowing once they get to a certain point. So once they get to that point, they've got to stop spending money. And that means someone somewhere isn't going to get paid for a while until they raise the debt ceiling. But of course, they always raise the debt ceiling so they can spend more. So the debt just goes up and up and up, and it's rising as a percentage of GDP at the moment in almost every country. What else is going on? Well, it wasn't just gold which was going through the roof. It was also silver. Silver currently $53.16. It was briefly down to $50 after I did my video on Tuesday, Thursday today. So that was 2 days ago. So $53.16. It's an all-time record. I don't know how long it's going to take me to upload this video, but I imagine it might be a long time given the slow internet speed where I am. But so the price could be anything by the time you get this. On Wall Street, despite the volatility, stocks are higher than we saw a couple of days ago. So let's just have a look at what happened there. The Dow Jones rose. I'm just looking for the figures here. Yes, the Dow Jones rose almost nothing. It was 0.04% to 46,253. The S&P rose 0.4% to 6671. These are records, by the way, and the Nasdaq rose 0.68. Oh, they're just below records, I think. 0.68% to 24,745. In Europe, the stocks index rose 0.04%, literally no change. We saw some large price changes around the world. SoftBank was up 6.5%. Samsung was up to 2.4%. Intel up 4.27%. AMD, Advanced Micro Devices, up 9.4%. These are all stories related to artificial intelligence. So as I've mentioned before, just about any company which has got anything to do with artificial intelligence, you only need a new announcement and the share price seems to just go up and up and up. We also had positive moves from a range of banks which came out with good news. The banks were JP Morgan, Goldman Sachs, Morgan Stanley, Bank of America. All of those banks over the last day or two produced results which were better than expected. It caused the share price to rise, and we wonder why. Well, I think it might be something to do with artificial intelligence. I'm just guessing here, but perhaps thanks to artificial intelligence, they don't have to hire as many people as they were hiring, and maybe the people who are working in the bank, many of them will now be starting to be more efficient. So I've said this before in other videos, the way to play the artificial intelligence game, if you feel that the AI stocks themselves are too high, is to buy the stocks which will be beneficiaries of artificial intelligence. And a beneficiary, do you know what a beneficiary is? No. Somebody who benefits from. So if you benefit from artificial intelligence. So a beneficiary of artificial intelligence is a company which is going to make more profit due to artificial intelligence. And one example of that, there's many others, are companies with huge numbers of employees, because some of those employees will become much more efficient because they are using artificial intelligence well, and some will not. And I'm sorry to say some of those will lose their jobs, but certainly these big firms with hundreds of thousands of employees won't be hiring nearly as many new people as they used to hire, so they'll be losing staff due to retirement and people looking for better jobs and things. But that could mean that the job count, which is a major expense for most companies, goes down. So they've got less employment expenses. That means the profits go up. So that's your way, one of your ways to play the AI boom if you feel that the tech stocks, the Mag 7, are too expensive. And I'll just finish off with a very funny thing which is happening in the silver market. Silver is currently in backwardation. What's backwardation mean? Backwardation. Backwardation is when the price of buying something in the future is less than buying it now. So normally with things like silver, gold, oil, soybeans, if you want, doesn't matter. All these things, you can go and buy them immediately, or you can say, I'll buy them in 3 months. Bless you. I'll buy them in 3 months because I don't need them now. But if you buy them in 3 months, it's usually more expensive because someone's got to store them, look after them for you for 3 months. And meanwhile, you're not spending the money. Bless you again. While you're not spending the money, you're earning interest on your money in the bank account. So it's quite normal in most situations that the price in the future, the futures price as we call it, should be higher than the spot price. Spot price is the price today. But what's going on in the silver market, is the spot price, that's today's price, is higher than the December price, and higher than next year's March 2026 price. Oh, that's the price if you agree to buy it in December. So if you go on the futures market and say, I'll buy silver in December, they won't give you the silver now, but you made a promise to pay for the silver, which they're going to give you in December. The price should be higher, but it's actually lower. What does this mean? It means that the short-term market, the paper market, the physical market where you can actually get it now, is very, very tight. People are running out of silver. There's lots of people buying the silver for whatever reason, and the silver just isn't there. So the price is rising faster, and people are saying, it'll be all right in 3 months, because in 3 months we'll have got some deliveries from the silver mines, and we'll have plenty of silver to deliver in 3 months, maybe. So that's why very, very unusual. This is an extremely unusual situation. I don't recollect ever seeing the the physical silver price being lower than the futures price. Of course, it has happened on occasions, but it's usually been very brief for a day or two, or not even a day or two, maybe an hour or two, or perhaps it's been brief in one of the months where there's not a lot of volume. But there's a lot of volume in the December contract. There's a lot of volume in the March contract. So there should be no reason at all why those prices should be lower than the physical price of silver on the spot market at the moment, but they are lower. So that's telling me that there's a huge demand for people to actually get their hands on physical silver, much more demand than expected. Now, there's lots of reasons why that's going on. Some people are talking about the shortage of silver in London, where the price is reputed to be trading. It only trades once a day at 12 o'clock, but that's called the fixing. The price is reputed to be higher than the fixing in New York. So we've got higher London prices than New York prices. And it seems there's a huge shortage of silver in London, and then what's called the lease rates. So silver's leased in London. There have been reports of the lease rates, i.e. the amount you have to pay to borrow silver, being as high as 30% a year. I don't know if that's true, and I don't have a way of checking it. But I've seen that commented by reputable organizations like Reuters. So we've got very high lease rates in London, a higher silver price in London, yet if you've got this, we've also got this rising spot price in New York. It's higher than the future price. So a logical thing would be to buy the silver spot in New York, fly it, not ship it to London. You want it to get there very, very quickly, and sell it in London at the higher price if you assume the price won't move. Or you could send it to London and lend it out, earning a very high interest rate. But there are dangers with that, because we don't know what tariffs might be imposed tomorrow. What if you fly your silver to London and lend it, and then the next day there's suddenly a tariff on silver coming back into the United States? Well, you might have to pay a 15 or 20% tariff to get it back again. So that's no good. So well, some silver will be flying to London. I think a lot of people will be very wary about doing that. So it's a very unusual situation. Some people say it's a short squeeze. The shorts, that's people who have sold silver they don't own. Typically a short, he will sell a silver future, like the December future or the March future, and he will buy spot silver, perhaps in London, or maybe he'll borrow silver and sell it on the spot market and buy the future, the December future. The way he plays the game depends on how he's trying to do it. They're often called shorts, but usually they're kind of neutral. But the problem you can suffer as a short is your silver might be in one place, but you have to deliver in another place. And that can cause difficulties if there's a disruption in the market like we're seeing at the moment. But we don't know which way it's going to play out, but obviously there are people out there who are saying the shorts are being squeezed, and therefore the silver price has to go higher. I wouldn't say anything other than saying that the silver and gold prices do look rather overbought. It's not a guarantee they're going to fall. If they stay where they are, things could come back to normal, or we could have this kind of dip we had the other day, where it dips down very sharply, and then it's no longer overbought, and then it's now set for a renewed rise. What we do know is that the industrial demand for silver currently exceeds the mined supply. That's been the case for a couple of years now. And to extract the silver which is needed by industry, we need to have recycled silver. So that does mean that a lot of silver, to get that recycled silver, you need to have a higher silver price so that people bring in their coins and their bars to the recyclers. But that apparently is happening. But what we're also hearing is that some of the recycling operations are now saying, we don't want to take in this recycled silver, or not all kinds of it, because we don't know where the silver price is going to be tomorrow. We're a bit backed up. We've got too much at the moment, and we don't want to take the risk that the price changes on us because we're not silver speculators. We make a profit from buying it at price A and selling it at price A plus one. What we can't do is buy it now and hope that the price will be the same next week or next month, because it's very, very volatile. So that must be contributing to the shortage of silver on the spot market, because the refiners are saying we don't want to do as much as we used to, because everything we're refining, we're taking a risk, and therefore maybe less is coming out of the refiners, onto the market for the people who want spot silver. Anyway, that's all I've got to say today, ladies and gentlemen. Any questions? Was it clear?
Yes.
What was the? Did you get any messages? What's going on in the world here?
Well, gold went down, plunged, and then it went back up.
That's right. That's called volatility.
Volatility.
So it's not the risk of losing all your money, unless you borrowed money or leveraged in some way, but it's called volatility risk. So the gold will still be there if you own it, but of course the price might be higher or might be lower than what you paid. And what do you think is going to happen to the price of gold next year? Now, this is not investment advice, ladies and gentlemen. It's just the opinion of an 8-year-old based on everything which can be known.
I think it's gonna go up.
And why?
I just don't know. I think it's gonna.
You don't know? Just think it's going to go. I think you're probably right. I think what's actually the reality here is there'll be more money on the planet in the future. And if there's more money, but not more gold, it means the relative balance has changed. So you can buy more gold with the money you've got. So when there's only the same amount of gold, you have to spend more money on it so it balances. In other words, the gold price will probably be higher. Good if you got all that. Thanks very much, ladies and gentlemen. You can stop the video now and say bye-bye. Bye-bye.
Bye-bye.